some of you are members of both AIA and ULI, so you're familiar with the annual Emerging Trends in Real Estate report compiled by PricewaterhouseCoopers with ULI. Others of you subscribe to updates from the AIA's Kermit Baker on the Architectural Billings Index. Well, we're pleased today to provide a forum to discuss findings from both of these sources, which are important indicators for our industry. First, it's my pleasure to thank our hosts and sponsors for today's program, PricewaterhouseCoopers. Please join me in thanking them for their hospitality today. At this time, I'd like to welcome Tim Trifolo with PricewaterhouseCoopers. He is an estate tax partner with the firm to kick off our program today. Tim?
Thank you, Mark. You did. Thank you. Welcome, everyone. It's a pleasure putting this forum together for you, and we at PricewaterhouseCoopers are delighted to have the opportunity to host you today. Today's program will begin with an overview of the 2014 Emerging Trends Report, which Mark said a lot of you might be familiar with, but this is one of our firm's premier publications. In fact, I think it's known to be the most, has the most hits, the most well-read, and we'll go into a lot of detail on that, so I won't spend a whole lot of time there. Next, we'll hear an industry forecast specific to architects reflected by the Architecture Billing Index and other data as compiled by the chief economist of the American Institute of Architects. The Architecture Billings Index, ABI, as you probably know it, is a diffusion index derived from the monthly Work on the Board survey conducted by AIA Economics and Market Research Group. The ABI serves as a leading economic indicator that leads non-residential construction activity by approximately 9 to 12 months. Now it's my pleasure to give you a brief introduction of the credentials for our presenters. First, Amy Olson from PwC. I had the pleasure of working with Amy here in Atlanta on the local impacts of some of the publications that we put out nationally, and some other endeavors within the real estate group. PwC has a multifaceted real estate practice nationally, and here in Atlanta we do everything from regular audits, tax work, consulting, transactions, valuations, you name it, for a mix of public REITs, developers, private equity groups, sovereign wealth funds, inbound, outbound, so pretty much a full service shop. Amy's been the senior editor of Pricewaterhouse's quarterly, I'm not sure if you're familiar with this, but the Real Estate Investor Survey, which is similarly situated in that we compile the data, but we go out and look for data from the professionals in the industry, which I think gives us the real benefit of the data. It's not something we're producing, it's really something that we're getting really from the people on the ground. Amy has 20 years of experience in the commercial real estate industry, focusing on market and investment analysis. During her 6 years with the survey, she's assisted in expanding the content with markets such as the medical office buildings and the national secondary office market, which you'll hear more about secondary markets as we go through as Amy goes through her presentation. For the past 4 years, Amy's also served as a contributing researcher of the annual Emerging Trends in Real Estate publication. Prior to joining the survey team, she managed the market analysis function for the National Real Estate Valuation Practice of PwC. Amy holds a BBA in Real Estate and Finance from the University of Wisconsin and a Master's in Real Estate from Georgia State University. She earned her CCM in October 2013. Next, Kermit Baker, welcome. You came in from Boston?
I came in from Boston today, yeah.
And it seems like you know the room pretty well. But Kermit is the chief economist for the American Institute of Architects in Washington, D.C. In this capacity, Kermit analyzes business and construction trends for the U.S. economy and examines their impact on AIA members and the architectural profession. Kermit originated the AIA's Work on the Board survey, a monthly assessment of business conditions at architecture firms and the source of the widely followed Architecture Billings Index. He also coordinates the AIA Consensus Construction Forecast Panel and writes regular economics columns for the AIA member electronic newspaper, AIA Architect. Kermit also is the project director of the Remodeling Futures program at the Joint Center for Housing Studies at Harvard University. This research effort is aimed at developing an improved understanding of the dynamics of the U.S. repair and renovation industry. Prior to joining the AIA, Kermit was vice president and director of the economics department at Reed Business Information, where Kermit was responsible for industry forecasting. During his 10 years at Reed, he developed the top U.S. construction markets report and served as editor of Reed Business Information's Building and Construction Market Forecast newsletter. Kermit received his master's degree in urban planning from Harvard University and holds a PhD from Massachusetts Institute of Technology in that same field. In 2002, Kermit was made an honorary member of the American Institute of Architects. Now, to get to the meat of the program, I'll turn it over to Amy to go through the Emerging Trends Report. Thank you, everyone, for coming. I'll talk later.
Turn that one off. Welcome, everyone. Thank you so much for coming. I'm glad we have such a great turnout. Marcy did not mention that if you do stay for the entire program, there's a reception afterwards that is serving beverages and hors d'oeuvres. So that's worth it to stay and hear all of our speaking. What I'm going to do, because I like to see my slides when I'm speaking, I'm going to be back here in the middle. First, we're going to start with emerging trends. How many of you are familiar with the Emerging Trends publication and have maybe been to the ULI and presentations in Atlanta? Well, as Tim said, Emerging Trends is one of the most predictive real estate publications out there. We're currently in our 35th year, and the information in the report is based on over 1,000 interviews and surveys of real estate professionals, anyone from investors, developers, planners, academics, analysts, researchers, all different gamut of people, real estate people that we interview personally and also do an online survey. And of course, our proud partner in this publication is the Urban Land Institute. What we like to do when we say we're most predictive, we need to go back and actually check to see if we were predictive. So we like to put together a scorecard to see how we did. So in terms of the trends that we talked about in 2013, emerging trends, as you can see with all the check marks in the yes column, we did pretty well. A lot of the things we talked about last year, or the respondents talked about last year, actually occurred. The economic recovery will help CRE prevent, the slow economic recovery helped from the CRE market from overheating. There was political uncertainty, concerns over the fiscal cliff. Interestingly, a lot of people mentioned that last year, and when it actually occurred, it was somewhat of a non-event in terms of how it impacted the commercial real estate markets in the long term. Secondary markets, as Tim said, we heard a lot about that, and we'll hear more about that going forward. The risk of multifamily overbuilding, debt, mezzanine debt and preferred equity investments, change in tenant demand, we'll hear a lot about that this year too, how demographics and different issues are shaping our space needs going forward, and the urbanization of the suburbs and other areas, urban areas. And again, a few more trends, you guys can read all those. One of the interesting things, the one that's highlighted in yellow, the single family housing funds, that was mentioned last year by a lot of our respondents, and it actually turned out to be a pretty big story in 2013 in terms of a source of liquidity for investors. The Big Six versus the field was something we talked about last year, if you saw last year's report. And the gist of that is that we talked about the primary markets that people always go to versus the field, which was sort of the emerging secondary markets. And we did sort of a compare and contrast on those. And again, the secondary markets are becoming more popular going forward. Development in terms of industrial space and distribution hubs. And then the other thing that's happened last year and this year even further, Washington, D.C. has fallen out of the top markets again this year and fallen further down the list. Primarily, respondents say, due to the uncertainty surrounding that particular area and politics. The first thing I want to talk about before I get into the ET 2014 information is some research that PwC has been doing on megatrends. And what we feel these are the big issues that are shaping the landscape of our business world and, of course, as related our real estate world going forward. So the first one I want to talk about is the shift in global economic power. This graphic shows you in 2009, the GDP for the G7 and the E7 countries. Fast forward 41 years, and you're looking at a tremendous amount of growth in the E7 countries. And so in terms of how this is going to impact our world, we have to think about the capital flows going among the different countries and globally, and now maybe targeting different markets, emerging markets, and how that's going to impact the mature markets that are already in place. And are people going to choose to invest in the emerging markets more than maybe perhaps some of the mature markets, which may lose a little bit of influence going forward? The second megatrend is demographic shifts. This is one of the things that we heard so much about in doing our interviews, and how the aging of the population, and if you look at the graphic, by 2050, 21% of the population will be over the age of 60. So increased longevity. Well, what are the issues we have to deal with? Not only do we have to deal with, pension costs and taking care of health issues with people living longer, but we also have to deal with, from a physical standpoint, how are we going to house all these people? Once you reach a certain age, traditional housing may not be for you. And then in addition to that, the hospitals that have to be able to accommodate all of these people, as well as the supportive development around that, medical office space, for example, clinics, outpatient clinics, nursing facilities, those types of facilities going forward. So that's where the real estate impact comes in. This is just a graphic that shows your population growth 2010 to 2050, and you can see which countries are sort of showing some of the emerging markets that are showing the potential for greater population growth than some of the other countries. The next megatrend, accelerating urbanization. Again, over the next 40 years, there is expected to be a 72% increase in the number of people that are living in urban centers. Now, this is kind of an interesting topic, because you think about how cities became urban areas way back when. Well, it was all around transportation. And back at the beginning, transportation was water, because that was the only way you could get anywhere. And then, of course, that progressed to other forms of transportation. But given the advent of all the technology we have and the different ways that we do business and work these days, there may be markets out there that you never thought would be urban centers, but they will become urban centers going forward. So just something to think about, and if some of these emerging markets become urban centers, it's going to take a tremendous amount of investment to get the infrastructure in, and the buildings and the different facilities that people will need in order to have a successful market. Yes?
Are the urban centers getting larger, or is just more people in the same area?
I would say more people in the same area, and because the nature of an urban center is that high barriers to entry. You can only go so far in terms of the land. So I think it's probably city to city. It depends. Atlanta has, compared to like a New York, you have a more land to deal with. But if you really are truly saying urban center, we don't have that far to go. We have to go up, more than out. The fourth megatrend, climate change and resource scarcity. Of course, this is a tremendously huge issue. We're looking at the need for more energy, more water, and more food, and how are the governments and businesses and just people in general going to adapt to these needs. And so the way that we build real estate, the way that we equip it is going to be different going forward. It's going to have to be in order to compensate for these factors. And the last one, technological breakthroughs. Now this is really interesting to me. The bottom gray bar, the connected devices per person. So you go back to 2003, less than one. Well, maybe most people just had a cell phone. Then you fast forward to 2015, and you've got almost 3.5 devices per person. And if you look to 2020, it's over 6 devices per person. I'm not sure how I could handle 6 devices per person, but I know that the young people can, because my kids can do multitask on various electronic things all the time. But this is interesting because even a firm like PwC, we've had to embrace technology, and it changes the way that we work, it changes the way we hire our talent, it changes the way we build up the talent in our firm. And so businesses have to adapt to all this technology, but not only does it change your people and the way they work, it changes the space. It changes the way, for example, in our office, we have hoteling. We don't need everybody here all the time, because a lot of people are working at a client because they can, or at home, that type of thing. And then in terms of, say, retail, how many people shopped online for Christmas? It makes a huge difference in in the type of industrial space you need. Sure, you need the distribution hubs to get the product to people, but you don't need necessarily the retail bricks and sticks as much as you did. And then when is the last time you drove in through the drive-through at your bank branch to make a deposit? I mean, we don't do business that way, and we don't really handle our personal lives that way as much as we once did. So again, technology impacting the way things are going to go forward. Okay, now back to emerging trends, 2014. We have two slides of the overall most popularly mentioned trends going forward. Profitability expected to continue to improve. So overall, the sentiment this year was even more positive than last year as far as looking ahead to 2014, just in terms of overall prospects for commercial real estate. Interest rates, of course, anticipated to increase. I mean, that's always a wild card. We're not exactly sure what's going to happen, but our participants, when this information was being gathered, which has been a few months now, did not appear to be overly concerned about that. The big story this year was cap rate compression will not be driving value. Instead, cash flow will be. And the hashtag authenticity, for those of you that are on Twitter, we do, one of our partners really likes to use Twitter a lot, and so we've come up with some interesting words and keywords in terms of how the results can be sort of broadcast and followed and conversed about on Twitter. But authenticity is referring to the cash flow or the NOI of the actual properties at the property level. And the reason that this is improving this year is because overall, across markets, the majority of things look better in terms of properties performing better, occupancies are rising, that kind of thing. And so that, we'll talk a little bit more about that later, but that is one of the key factors that people mention, that this year, in terms of value, cash flows are more important and more authentic. Markets are expected to be well supplied with both equity and debt capital. No one mentioned a shortage of capital in 2014. They feel like capital is readily available. And in fact, a lot of people mentioned capital going wide. And what we're referring to is not only going wide in terms of geography, going into secondary markets, not just investing in the gateway markets at the coasts and that kind of thing, but also at the property level in terms of investors being a little bit more willing to pay for a property that maybe needs some lease up or maybe needs to be repositioned. And they feel that because the economy is improving and different things are going on that are positive, there are some opportunities out there for that kind of investment. Opportunities to develop finally appear in sectors other than multifamily. Of course, the last several years, the darling of commercial real estate development has been multifamily, and now we're seeing that spread to some of the other property types. The industry, this is one of the megatrends, industry beginning to take notice, of course, of the millennials and the baby boomers and how that impacts the demand for real estate and different types of real estate. New credit sources entering the market. Shadow banking is something that they talk a little bit about in the report, and basically that's referring to sources of credit that are away from the typical regulated institutional type of sources. So maybe something like a private equity fund or REITs, something that's will become a little more active, they think, in 2014. And again, the needs of end users in their commercial space and how those needs continue to evolve. And then another big story, the single-family housing market improving this year. It's been a drag on many markets for quite a while, and now it seems to be making an overall positive contribution to the overall economy and commercial real estate. Okay, this pie graph, this is a little crazy graph showing you the improvement. I'm going to go back, and when I go back, it may go forward again, but basically, if you're not familiar with emerging trends, we score it, or the respondents score the overall potential for the real estate market in the next year on a scale of 1 to 9, 1 being abysmal, 9 being excellent. So what these pie graphs are showing is the percentage of respondents that rated the markets on an overall basis, good to excellent. So if you go back to 2010, you can see that just under 20% rated it good to excellent, and then of course the improving pie to where 2013 is, as we say, we thought we hit it really big in 2013, but then 2014 came out and almost 68% of the respondents rated the prospects for commercial real estate in the next year as good to excellent. So that ties into the sentiment being very positive looking forward. A couple of these charts, I just want to go through in a little more detail some of the trends. Last year it was the chase for yield, and this year it's about cash flow authenticity. Again, this graphic is showing you the improvements in occupancy relative to the averages. The yellow line is the average occupancy over time, and then the bars are the quarterly occupancy, and then versus NOI growth. And so what you're seeing over to the far right is that things are trending upwards, and cap rates have lowered to the point where they're probably not going to go a whole lot lower. And so your value, you're creating value with NOI growing instead of cap rates falling. Development, of course, another big story. The development ratings on each of the individual markets, which, by the way, at the end of this, I'll show you a URL, and you can go download the entire PDF of Emerging Trends if you'd like. There's a lot of great information in there. It's really outstanding. But anyway, the development scores, because Emerging Trends rates each market based on investment prospects, development prospects, and home building prospects. The development prospects were higher this year than they've been in quite some time, as you can imagine, because as this quote at the bottom, conditions in certain markets have reached a point where new development is actually feasible. And not that we think there's going to be stuff popping up everywhere, or not that the respondents think that, but definitely outside of just multifamily, we expect to see strong industrial development, perhaps some office in certain markets, in certain submarkets, and that a little bit more than we did last year. Again, the housing market story, the fact that it's not a drag on many of the markets it once was, such as a Phoenix or a Miami, but seems to be helping things along, and the aggregate demand for housing increasing here in the recent past. Again, the population by generation, this is a big thing, and it has to do, investors are very aware of how these age cohorts are growing in certain markets, and they want to be in markets where the 15 to 29 age bracket is showing the potential for growth or growing because they feel like those are the markets that are going to have the most success in the near term. The influence of the demographic shifts, what this particular chart shows is the growth in the millennials for the nation going forward. Obviously, that's going to become a bigger and bigger portion of the population, and it's becoming one that we need to pay attention to. I just put in a couple of charts on capital flows. The great thing about the Emerging Trends report, if you download it, is that there's so many great quotes in there. It's hard to pick the good ones to put in the presentation because there's so many clever ones. But real estate market activity is a function of the availability of capital, not the cost of capital. So that was another overriding theme for this year, and the fact that there appears to be a strong availability of capital this year. North American real estate remains attractive. What this chart shows you is the change in availability of capital from different sources for 2013 and 2014. And as you can see, the bars are pretty close together. There has not been a whole lot of change in terms of the scoring and the ratings of these different sources of capital. And investors, the takeaway being investors are still attracted to the income potential of commercial real estate. Traditional lenders expected to remain active. Again, not much change from last year to this year. A lot of people mentioned the CMBS market, expecting a lot more activity out of that particular source. But other than that, things kind of along the same lines. And then transactions. You have markets that, another thing that we rate in the Emerging Trends is markets as a buy, sell, or a hold market overall. Atlanta was actually rated as a hold this year. But so what you're seeing is the bar shows you overall what the consensus was in terms of the upcoming year in terms of buy, hold, or sell, the sell recommendation, whether it was abysmal, fair, or excellent. And as you can see, that's been increasing and gotten better. The sell sentiment has gotten better over the last couple of years, and the level of transactions have also increased. And so given that there's a lot going on, there's capital available, many of the respondents feel like 2014 will be another strong year for transactions. But the question mark shows us that remains to be seen. We'll have to fill that in next year. Okay, markets to watch. This was a great quote, I'm sure by someone in Houston, Dallas, or Austin. if markets like Texas, where development is already underway, are an example, the country should see some real resource shortages when development ramps up in more markets. Now, I don't know, that sounds a little extreme to me, but you never know how fast development's going to get going. But the point being that the Texas markets ranked very high this year, and they've seen Houston, Dallas, and Austin have seen some solid, particularly Houston, solid employment growth. And that has driven the success of those markets, and their recovery from the recession has been very strong. This shows the outlook for markets from 2011 to 2014, and these markets have the investment prospects of good or better. So back in 2011, there wasn't much good to be talked about, New York and DC. 2012, add a few more cities, primarily cities with high-tech employment, San Jose, San Francisco, Seattle, Boston, and then about the same situation in 2013, and then 2014, we fill the column with the sentiment being good or better for investment prospects in those markets. And again, you see Austin, Dallas, Houston, Miami was a new one this year that popped up in the rankings, but Washington, D.C. is clearly out of the rankings. So you can see sort of the trend in the different cities that are mentioned with the high rankings. And years ago, Washington, D.C. was either top 5 or top 10 consistently. This is the overall ranking of the 51 markets, starting from the highest in the upper left, San Francisco, to the lowest in the lower right, Detroit. Green being good, yellow so-so, red not so much. So again, not a whole lot of change in the top 5. Dallas and Austin kind of flipped spots. Miami moved up quite a bit. Atlanta, you see at the bottom of the second column, Atlanta was 26th overall, which was up 9 spots from last year, so that was positive. And the markets that they're in the top, again, high tech, strong employment growth, good demographic trends, and the markets to the right are those that have not had success in terms of diversification of employment or organic growth in employment, that kind of thing. And frankly, those a lot of times are toward the bottom in terms of the scoring. And this is just a little bit of a graphical view. You can kind of see the where the green is clustered. You know, California, a lot of green. Texas, Florida, almost all green this year. It just kind of gives you a snapshot of where we are. And if each emerging trends report, at least as far back as I can remember, has this map in it. So you pull out, 2010 or 2009 and lay it next to this one, it'll be quite a different picture in terms of the color scheme. And this shows the Southeast and the overall scores for some of the markets in the Southeast. Atlanta, Nashville, Raleigh, and Charlotte pretty consistently above 6 on the scale. Charlotte, their financial services has stabilized somewhat. Nashville's seen a lot of activity. Raleigh-Durham continues to attract brain power in the research triangle, and Atlanta has been having some recent success in employment and coming back with a little more vengeance as of late. Here's a couple of things to point out about Atlanta, and again, in the ET report, there's a big spreadsheet that has a lot of these indicators for all the markets, and so it's a really neat comparison to look at. It takes up 2 pages in the report, but it's a good, sort of a good benchmark kind of table. Millennials, interestingly, in Atlanta represent about the same as the U.S. average in terms of what percentage of the population they take up, whereas their growth rate over the next 5 years here in Atlanta is supposed to be considerably higher than the U.S. average, so that's a very positive thing. Disposable income growth, 5-year average looking ahead, 3% versus 9%, which is interesting that is on the lower end compared to the U.S. average. The home affordability index higher than the U.S. average, but the rent as a percentage of household income lower than the U.S. average. All the sources and whatnot are on that table in the big ET book if you want to take a look at those. But I just wanted to give you a little bit of a snapshot of where some of the stuff falls for Atlanta. Again, the big draw, Texas, Tex and Texas, hashtag, again, Tex and Texas, say that 3 times fast. What this graph is showing you is markets that have returned to what percentage of their previous peak of employment have they returned to. So the average, or 100% rather, is the yellow line. So as you kind of can see that markets to the left where they've returned to above average, or above their peak, previous peak, tend to have higher rankings in the overall ET rankings than the markets to the right that haven't quite gotten back to that. It's just some, these next couple slides show a little bit of correlation of some of the factors that we feel maybe explain some of the rankings a little bit better. Again, the scatter graph, and this is the gross metro product per worker on the left. And so the colors are not great on this one, but the middle fair is yellow, and then over to the right, the good to excellent. And you can see a little bit of a trend in terms of higher gross metro product per worker, higher ratings in terms of commercial real estate in the emerging trends report. And then this last one, of course, as I mentioned, I feel like I've mentioned it a lot, but we heard it a lot, a correlation between growth in millennials and growth in employment and how those markets rank in terms of real estate professionals. And again, the upper right quadrant shows a lot of markets that have the expected strong growth in the millennial population as well as employment, and then a lot of those markets had higher rankings in emerging trends. I don't know if any of you are familiar with walkscore.com. This was something we put in the report last year, and the correlations were really interesting. The WalkScore gives each metro area a score based on basically how pedestrian friendly they are. And so what we've done is put those the scores for the markets that we track in emerging trends. And as you can see, the middle dark line being the average walkability for the U.S. Markets to the left, which have higher than average pedestrian friendliness, generally rate a little bit higher in the survey overall versus the ones on the right, which don't have that. And that ties into the urbanization and people wanting to live, work, play, just like Midtown Atlanta is a perfect example of walkability and how successful it's been in terms of having all those amenities right here that people don't have to leave Midtown. They can work here, they can live here, and they can have fun here. So just another way to look at sort of the thought process behind maybe how these real estate professionals are rating these markets. The last section we're going to talk about is property type. And of course, we've mentioned changing tenant needs require older space to reconfigure or risk becoming obsolete. So with the advent of all the new technology and the different ways people are working, real estate has to be adapted to those different parameters. This year, industrial kicked multifamily right out of the way in terms of the top spot and was the most favored property type, and then followed by hotels, and then multifamily bumped down to third, followed by office and retail. And I think multifamily had been in the top spot probably for the last 4 years, if not 5 years. And these next 4 charts, I have one for each property type. As Tim mentioned, one of the publications that I work on is the PwC Real Estate Investor Survey. And we have a section in that is basically our version of a real estate cycle analysis. We call it the PwC Barometer. And what we do is based on a variety of indicators. We place markets where we think they are in terms of the real estate cycle, and then we do an aggregate for the U.S. And so what this chart is showing you, this is the industrial market, the percentage of markets by inventory or stock of space in each of the various cycles. So you can see this is by the end of 2013, 2014, 2015. So by the end of 2013, for example, 44% of the U.S. industrial stock is expected to be in the recovery cycle. And of course, that percentage, given where industrial is right now, is increasing over the next 4 years based on improving occupancies and a variety of different things happening. And so then the amount of space in the recessionary phase of the market cycle is shrinking, and of course expansion is also increasing. But if you take note of the color scheme of this bar chart, and then you look at the next property type, multifamily, obviously a totally different picture, because the multifamily market has already been on its way up over the last several years. So you've got 87% in the expansion phase, and then that actually increasing a little bit and then falling down a little bit toward 2016, because we feel some of those markets are going to sort of max out in terms of rents and cap rates and different things, and actually start their move into the contraction phase, which changes things a little bit. Not very many, but select markets, but still, I mean, the overall takeaway being that things still look strong for multifamily over the next several years. And then the next property type, the office market, sort of in between. You see some in expansion, some in recovery, and a shrinking amount in recession over the last several years. I mean, over the next several years. And by 2016, 66% in the expansion phase. And retail still has the most in red, but we're improving. Things are looking up. Recovery, a lot in recovery over the next 4 years, and even some more moving into expansion. So it just, I like to, they are kind of neat side by side. You can just kind of see where the different property types are compared to one another. And so instead of always just looking at the different cities, it's kind of interesting to look at the different property types. Okay, so this will be this is, when we get together next year, this is what our scorecard will look like. These are the main trends that we pulled out of the ET report, and we'll have to score ourselves and see how we did in terms of what happens in 2014. Profitability improving, rising interest rates, emphasis on property management, the hashtag authenticity, more on the property, and the property performance is expected to improve, plenty of capital available, development opportunities, industry changes to meet generational needs, that will be a big one, and the needs of end users, and finally, single-family home market continuing to improve, which hopefully will continue to be a positive sign. So that's all I've got for you guys. As I promised, the URL for downloading the entire report, if you would like to jot that down, and I believe Marcy will probably make these slides available to everybody at some point. And my contact information, if you ever have questions about ET, want to know more about our PwC Real Estate Investor Survey. I'm on Twitter. I'm a relatively new Twitter person, so I can always use followers. And I tweet about the survey and about ET and just about different things going on, research we're doing at PwC and some other things. And of course, the PwC Twitter handle has a lot of great stuff out there too. Anything from leadership to different kinds of businesses and industry trends just across the board. So they really put a lot of great stuff out there. So that's all I have. Does anyone have any questions now, or do we want to hold off? So
We have time for a few questions if they are.
everybody's good? That means I covered my material. That's great.
I'm going to look at this really more from the construction perspective. Amy talked about it from the real estate or investment perspective. Those two can be sort of mirror images of each other, but they don't always align. And so I think you'll see some places that trends are very similar, and you'll see some places that they are moving in slightly different direction, or just sort of a different take on them. I'm going to be talking about two major issues this afternoon. I'm going to start off very briefly talking about some trends that we're seeing in the residential markets. And I'm also not going to use a microphone, and if that's a problem, let me know. But I think this room has good enough acoustics that you'll be able to hear me. But like I say, let me know if that's not the case. So I'm going to talk about real estate markets for a few minutes, but then quickly get into the non-residential construction area, spending a fair amount of time really telling you what you folks have been telling us. Sort of the what's going on in the architecture professions, how architects are seeing the non-residential construction market shape up, and what some of the key issues we're going to deal with. I'm going to present just one slide talking about the broader economy, but I think it's an important perspective to get started on. So this is a leading indicator of the economy. This is developed by a group that tracks business cycles, and just wanted to give you some sense of what this seems to be telling us about near-term trends in the economy. So we went through a very serious recession, but I think really what's more characteristics of this is that this sort of roller coaster continued for quite a while after that, sort of good numbers, bad numbers, good numbers, bad numbers. And if you look at that, it also really wasn't doing much, showing much gain. And kind of coming out of the recession, things really sort of, the roller coaster, but really sort of plateaued in terms of growth in our economy for several years. And it's really been only the last year and a half that we've seen the market begin to stabilize, the economy begin to stabilize a little bit. We've seen it trend up a little bit, We're sort of out of this, at least for the time being, out of this roller coaster pattern that we've seen in the economy. A bit of a hiccup last fall when the federal government shut down, but as you can see, a pretty minor hiccup, and generally things seem to be moving in the right direction. This is obviously very important from a non-residential construction perspective. Businesses don't like to invest in new facilities unless they have some confidence about what's going on in the economy and what future demand is going to be. And I think in this environment, a little more confidence that maybe things are going to stabilize and slowly trend up than we've seen for the last 3 or 4 years. But like I say, just one comment on the broader economy, and let me get into what we're seeing in terms of the housing market and some of the key housing issues. And as Amy suggested, the housing market has come back, and has come back very strong, beginning really in late 2011, and we've seen housing not only an important construction market, but really one of the strongest sectors in our economy. So macro economists are talking about what's going on in housing and how important that is to broader economic growth. And house prices, the trends we're seeing in house prices, we'll talk about that in just a minute, are obviously very critical in terms of what the housing market's doing. Secondly, though, the demographics, and Amy talked a little bit about that too, the demographics are not nearly as strong as some other parts of the economy, and I think that's or other parts of the residential market. I think that's helping to explain why the multifamily side is doing a little better, or has a little bit better than the single family recently. And then moving forward, with all the strength we're seeing in housing, the numbers have been strong for the last year and a half or so, and as I'll show you, predicted to stay strong for the next couple of years. We're still not back to sort of normal levels of production. Over the last several decades, we've built somewhere between 1.6 and 1.8 million housing starts a year. And even with a couple good years behind us and some more good years ahead of us, we're still not back to that level yet. So a lot of catch up. And let me just begin by reviewing some of the numbers that we're seeing here. So I talked about sort of the long-term trends. In 2012, we had 780 housing starts nationally. Good strong numbers you can see throughout, beginning in the end of 2011 through 2012 into the first quarter of 2013. Then a bit of a pause over the summer, second quarter, third quarter numbers softened a bit. Looks like the fourth quarter is going to see a nice strong uptick, so it looks like we're entering 2014 on with a good bit of momentum. Looks like the number is going to come in for 2013 about 920,000 housing starts nationally. So good solid growth, about 20% growth last year. So good numbers, and a lot of that really has to do with what we're seeing in terms of house prices, and that's really what's been driving the market during the downturn. That's what's been driving the market during the upturn. So we had as you all well remember, I'm sure, a dramatic decline in house prices nationally, beginning around the first quarter of 2006 and falling off down through early 2009, fell about a third nationally over that period. That was bad, but I think what sort of made it worse is that once they apparently hit bottom, they didn't move off of that bottom. So we had house prices that stayed at those depressed levels for about 3 years, and it wasn't until, as I said, end of 2011, beginning 2012, that we started to see a sustained recovery in house prices, and the recovery that we're seeing in house prices nationally has been really quite strong. So through the most recent numbers we have through the end of October last year, house prices have gained back almost half of what they lost during the downturn, 43, 44, 45%, something like that. So clearly on a nice trajectory moving back up there, and I think that's really what's causing the good numbers that we're seeing in terms of the housing recovery. So I said, though, the demographics are not quite so strong. Household formations are what triggers home building demand for home building activity. Household formation is A child leaving home and renting an apartment, that's a net household formation. Couple getting married that lived with their parents prior and buy a home, that's a household formation. So historically, we've seen 1.1 to 1.2 million net household formations a year, and that's what drives housing demand quite fundamentally. Now, during the peak of the market, as you can see, 2004, 2005, we were well above that level. We were about 1.7 million household formations a year over that 2-year period. Something that really couldn't be sustained. That was, the demographics just were not supporting it. And when that turned very quickly from 1.7 million and blew through this sort of 1.1, 1.2 that we've seen historically, all the way down to 500,000, 600,000 household formations a year for an extended period of time. That's number one. Number two is the tenure choices that households were making. So back in the boom market, 2004, 2005, virtually all, overwhelming majority of those net household formations were owner households. And then when the market turned, we saw slower levels, but we saw most of that drop off on the owner side, 2006, 2007, and beginning in 2008, we have seen a net decline in the number of owner households, whereas pretty solid growth, reasonably impressive numbers on the renter side, the net gain in renter households. But we continue up through the numbers we had last year, seeing a decline in owner households. So low levels of household formations, decline in the number of owner households, pretty strong growth in the number of renter households. And that's showing up in that line there in terms of the national home ownership rate, 69% at the peak of the market, really at or near record levels and not sustainable, but all the way down to 65% currently, and likely to go a little bit lower even before they recover and start to head back up again. So what's the outlook for housing before I get on to non-residential construction? Just sort of take the numbers from a lot of the institutions and operations that forecast housing starts and simply average them to see what they see happening this year and next year. And those growth rates are really pretty impressive. So last year, as I said, about 20% growth. This year, consensus is up another 25% to 1.1, 1.2 million housing starts. 2015, that optimism continues, another 25% growth in terms of home building activity. Up to 1.4 or plus. But like I say, even with a very strong growth last year, projected growth this coming year and in 2015, that still doesn't take us back to the long-term trend that we've seen in housing and really what we as an economy can support given traditional levels of population growth and household formations overall. So let me move on now, as I said, to some of the issues we're seeing on the non-residential side, and let me start kind of running through the topics I'm going to talk about over the next several minutes on non-residential activity. The first is sort of, as Amy was talking about, the recovery that we're seeing in this market, and we are seeing signs of recovery, but I think the takeaway is that the recovery to date has been extremely modest, particularly in light of how far this market fell off during the downturn, and I'll show you some numbers there. So that's been disappointing. On the other hand, I think there is a good solid foundation in place for a solid recovery in non-residential construction. I'll talk about that. We worked off a lot of the excess inventory that we had built up prior to the downturn. Commercial property values have recovered nicely. Vacancy rates trending down. Rents are trending up on the commercial side. All those point to really pretty healthy levels of demand for commercial properties moving forward. And then finally, what I'll talk about is what architecture firms are reporting in terms of design activity, what trends we're seeing there, and what that implies in terms of future levels of construction activity. So let me begin by just kind of reviewing the lay of the land here in terms of what we're talking about when we talk about non-residential building activity. So we net out the public works stuff, streets and highways and things like that, talking about things that architects generally are involved in, and that's the building side. And what I've got here is sort of a 10-year average of what we've seen in terms of building activity nationally. So these shares do move around a lot depending where we are in the cycle. So I wanted to give a full decade worth to see sort of on average where we see these trends playing out. So over the last 10 years, we've seen $380 billion on average of spending nationally for non-residential buildings. As I said, higher than that on some good years, lower than that on some bad years. Commercial and industrial facilities account for about 45% of building activity in a typical year. Retail and offices are the biggest slice of the commercial industrial side. Institutional sector averages over 55% of spending on buildings. Education, far and away the biggest piece there. Healthcare, a fairly distant second. And as I said in my introductory remarks, this recovery has been disappointing given how far we fell. So peak of the market for non-residential building activity was 2008. We generated fully $500 billion in spending on non-residential buildings that year. And then between 2008 and 2011, we lost a third of market spending over that 3-year period. Last year, actually 2012, bit of recovery. 2013, not so much, kind of moved sideways there. But I think, given the 33% or so decline that we saw in spending over that 2008 to 2011 period, these numbers we're seeing now, although generally moving in the right direction, as I said early, a little bit disappointing. And I think we would expect a sharper bounce back in spending on non-residential activity, given how steep this downturn was that we saw. We did, fortunately, see some slightly better numbers as we moved through the year.
Sorry.
Spending, little sound effects there, right? Spending was essentially flat last year on non-residential buildings. I've got here just the November numbers, November 2013 compared to November 2012, and towards the end of the year we did see a bit of an uptick. Spending in the building sector is up 12%, double digit on the commercial industrial side, with virtually every category up at a pretty good pace over this 12-month period. Institutional up a little bit at this sort of high water mark. Institutional probably down for the year. As you can see, most of the major institutional categories were declining or saw very slow growth even over this period where we saw generally good gains. So, end of the year, a bit of an uptick, but still haven't seen a full-blown recovery yet in terms of spending. But as I mentioned, the fundamentals are looking pretty healthy. I think we do have a solid foundation for a non-residential building recovery, and I think point number one is property values that we're seeing on the commercial side. More difficult, obviously, to measure property values on the institutional side. But on the commercial side, a lot of volatility. So, I talked about house prices and where they moved during this cycle, and a lot of coverage in the press about what happened to house prices, not so much coverage on what happened to commercial property values. As you can see, those were every bit as volatile as house prices, even really more volatile. The peak to trough decline on the commercial property side was actually a little bit steeper than it was on the housing side. Difference, though, is house prices peaked and started to fall off. Commercial property values peaked about a year later, started to fall off. Both hit bottom about 3 years later. House prices stayed on that bottom for 3 years, as I mentioned. Commercial property values started a nice sort of traditional recovery. and came back just about as fast as they went down. So we've seen a good healthy recovery. Commercial property values have increased by more than 40% since their trough in early 2010. I said even with the housing numbers coming back strong recently, they're only up about 25% from their low point. So we've seen a much more significant recovery on the commercial side than we've seen on the residential side. Other fundamentals, vacancies and rents. This is looking at nationally at office vacancy rates, and a big difference between the residential and non-residential markets is that the non-residential buildings, by and large, were not overbuilt, were not nearly as overbuilt in most areas of the country as was the residential market. So we can see that even with this slowdown in the office markets, and it was a pretty dramatic slowdown in 2009, 2010, 11, the vacancy rates nationally didn't fall, didn't grow any higher than they did during the prior downturn, this 2002, 3, and 4 downturn. Even though the fall off, as I said, was much more dramatic there. What we are seeing, though, is obviously, coming out of this peak in terms of office vacancy rates, we've seen a very slow recovery. But because of that slow recovery, we're seeing, a fair amount of variation in terms of office vacancy rates across the country. These are numbers from Cushman and Wakefield. They're reporting that as of their most recent release, third quarter 2013, the national office vacancy rate was 15.8%, just below 16%. But as you can see, a lot of variation. They track 43 markets, and a lot of the coastal markets, coastal California, New York, are seeing office vacancy rates just barely into the double-digit range, where some of the overbuilt Sunbelt markets still seeing office vacancy rates in excess of 20%. Atlanta, unfortunately, a little closer to the second category than the first, not in the bottom 5 in terms of the highest office vacancy rates nationally, tracked by Cushman and Wakefield, but not too far off the mark, as you can see, well above 19% as of the most recent reading. And Atlanta, traditionally one of the fastest growing metro areas in the country, is still, I think still the numbers point to being in a recovery phase here. In terms of office space, Cushman and Wakefield has Atlanta as the 7th largest market in the country, 140 million square feet of office space in the Atlanta metro area. But of I mentioned that they track 43 major markets, Atlanta in the bottom quartile in terms of office vacancy rates at present, about 3.5 percentage points above the national average. Because of that, in the bottom quarter in terms of office rents too, just $21 a square foot that they measured, again well below the national averages. So it seems like it's going to take another year or two of growth before Atlanta kind of absorbs this bit of an inventory overhang that it's dealing with. In terms of national trends, again, getting back to sort of the fundamentals that I mentioned, and they are looking pretty solid. So these are numbers from the Urban Land Institute. They do a semi-annual consensus survey. They've got about 40 participants, and they look out a couple years in terms of basically vacancy rates, or that concept, and rents for the major property types, starting with apartments. And the reason I have that as negative is not that those numbers are negative, but they do seem past peak. As Amy said, sort of the later stages of the cycle on the multifamily side, because the growth started a lot earlier because of the demographics I talked about earlier. We're seeing strong growth in terms of renter households, and so we've seen improvement in that market for several years now. It looks like that that improvement is slowing down, which is why I gave it a negative. But you look at the other commercial markets, offices, stores, hotel, manufacturing, those vacancies, rents are all improving and improving at a growing pace. So those are still early in the cycle. One exception being this on the hotel side, RevPAR, revenue per available room, sort of the concept of rents on the hotel side, looks like it may be slightly past peak in terms of growth. And again, the hotel market, the second strongest market we're seeing right behind multifamily construction. So again, maybe entering the later part of the cycle there, but all the other ones seem to be early cycle recovery, and as I said, strong fundamentals that to generate growth. So let me look now at information that we're seeing from architecture firms, what they're telling us about the state of the non-residential building markets and what trends they're suggesting moving forward. And let me just, a little background, talk about sort of business conditions at architecture firms. And one way to track this is payrolls at architecture firms nationally. So we've got about somewhere around 18,000 architecture firms in the country as of 2007, 2008, numbers pretty close. We had about 214,000 payroll positions at these 18,000 architecture firms nationally. About 60% of those positions are architecture-related positions, providing architecture services. The remaining 40% are other design professionals. They may be engineers or interior designers or something like that. Includes technical staff, marketing staff, administrative staff, things like that. So during the downturn, architecture, like virtually every slice of the construction industry, was really hammered pretty hard. Lost 60,000 positions nationally from 2007 down to 2011. That's the bad news. The continued bad news is this recovery that we've been in for 2 years really hasn't generated a lot of growth. We've added, according to these government numbers, about a little over 3,000 positions, payroll positions back over the last 2 years. 3,000 out of 60,000 loss, not really good odds. So you're only 5%, 5% back of what we lost. And most architecture firms I talk to think that they're going to continue at lower levels of staffing moving forward. Very few firms I talk to that say, we really want to get back to 2007, 2008 levels, and we want to get back there right away. What we're seeing in lieu of that is a little bit more activity on the merger and acquisition side. I think firms that do want to grow are seeing that there are advantages of merging with another firm, acquiring another firm, rather than this internal growth. I think that was more typical during the last run-up. But let me get into our billings index. We've been tracking business trends at architecture firms since 1995, so we have a pretty good track record about what's happened at architecture firms nationally and how that is correlated with construction activity. What we've discovered, no surprise to you, I'm sure, is that design activity is very highly correlated with construction activity. You need to design it before you build it. And number two, that design activity traditionally leads construction activity by 9 to 12 months. So, the information that you folks are supplying in terms of revenue activity at your firms provides a really nice, neat, accurate indicator where the construction activity is headed. And recent trends have basically been very favorable. You can see sort of bouncing around a lot, but the last year and a half or so, seen a lot more pluses than minuses. This is an index that you're probably familiar with. Let me just run through it quickly. It's centered around 50. So any score above 50 indicates that design activity is picking up nationally. Any score below 50 indicates that it's declining nationally. 14 out of the last 16 months Our Architecture Billings Index score has been above 50, so 14 of the last 16 months. We've seen growth in terms of design activity, some reasonably healthy numbers, some numbers just kind of on the cusp there, as you can see, and unfortunately ended 2013 on a bit of a down note. So trending up, but not every single month, and still a lot of volatility out there. And I think a lot of you are still seeing that in your practices. We also break this down by the major building sectors: retail, commercial, industrial, institutional. No surprise after what you've heard from both Amy and myself, the residential index is the strongest. These are architecture firms that concentrate their practice in the residential sector. So we saw multifamily activity been strong for several years. Architects very involved in that. Single family activity strong for the last year and a half, 2 years. Architects not so involved in that, but some activity. And thirdly, home improvements, residential remodeling, been a very strong market, and architects getting some activity from that. Commercial industrial did see some strong numbers, started to wane a little bit as we ended up 2013. Institutional numbers later in the cycle, turned down later, recovered later, generally more stable. Generally don't see the volatility on institutional work that we see on either commercial, industrial, or residential. Declining until a little over a year ago. Then we saw sort of almost a steady year of very modest growth in institutional buildings and institutional activity. That again towards the end of last year kind of softened a little bit. So we've got both the non-residential sectors that eased a little bit as the year ended. Hopefully, in the new year we'll see those rebound a little more strongly. And then finally, the regional numbers. So we break this down by the 4 major regions of the country. Prior to the downturn back in up to 2007, 2008, we were seeing the strongest numbers coming out of the Sun Belt firms, the South and the West. When the downturn hit, markets were more overbuilt, more of an inventory overhang in those Sun Belt regions. So we saw those numbers fall a lot faster, and we had 3 or 4 years where basically the firms in the Midwest and the Northeast were doing better than Sun Belt firms. That has started to reverse again recently. Now that we're sort of moving back into this recovery, we're seeing the growth concentrated in the Sun Belt regions of the country. So expect to see firms in the South and West show some stronger numbers moving forward. What we ended up the year with was some really weak numbers out of the Northeast. The other 3 regions kind of doing sort of so-so, still positive, but easing a little bit. So again, like to see those strengthen a little bit. And then our construction forecast for 2014 and 2015. This is not coming from our Architecture Billings Index work, but this is coming from a separate effort we call the Consensus Construction Forecast Survey. We go out to the major forecasters in the country, ask them what they think is going to be happening in terms of construction activity over the next 2 years, and we simply average that to develop our consensus. So I've got the line on the left there is in dollar terms. That's how big the market is. That's our estimate of spending in 2013 on each of those sectors, and then 2014 and 2015 measured as percent change on the growth. So overall non-residential building activity, mid-single-digit growth this coming year, upper single-digit growth in 2015. This is, as you remember, on top of basically no growth that we saw in 2013. Stronger on the commercial industrial side, as we talked about, tends to come earlier in the cycle. Private sector money flowing into our economy stronger now, so double-digit growth on both 2014 and 2015 projected on the commercial industrial side. Institutional, which has not seen a recovery yet, looks like 2014 is going to be, I'm not going to use the term breakout year because it's fairly modest growth, but at least beginning with a plus sign, which we haven't seen from that sector in a while. A low single-digit growth in 2014, accelerating somewhat to mid-single-digit growth in 2015. So it looks like, as I said, recovery underway, starting to build some momentum, but still essentially in the single-digit side moving forward. And let me just end up talking a little bit about what's likely to happen in these markets moving forward beyond 2014 and 2015 as we kind of move through this cyclical recovery and get into, kind of how much growth can we expect to see, over the next, 5 or 6 years coming out of the construction sector, and what type of growth are we likely to see coming out of that. So some slides similar to information that Amy talked about. I think looking at demographics gives you the best sense of how much growth we're likely to see and what segments of the construction industry are likely to feel that growth the strongest moving forward. So I'm going to start by looking backwards. This is actually looking at 2000 to 2010 population growth by age category. So what we've done here is we've taken population numbers from the 2000 census, broken them into age categories, take population numbers from the 2010 census, break those into the same age categories, and look at the difference between 2000 and 2010 by age category. So the Census Bureau tells us that there were 27 million persons added to our population between 2000 and 2010. And like I say, when you do this comparison, this is how they break down age-wise. So those bars, if I've done this right, should add up to 27 million people. So what's going on here? You obviously see one huge bar and a lot of little bars around that, and that's simply baby boomers at this point moving into this 45 to 64-year-old age group. Baby boomers were moving that age. They were replacing a much smaller population cohort that preceded them. Behind them are the Gen X and the Gen Ys, two very big cohorts also, but not bigger than the baby boomers. So those numbers behind them are quite small. They're kind of comparable to the baby boom population that they're replacing. So what's the takeaway from this? Well, what does this tell us about construction activity? What if we were sitting here 10 years ago looking at these numbers, and these numbers would have been very similar. Demographic projections are pretty stable. What would we think would be some of the construction implications of this 27 million persons added to our population broken down by these age categories? Well, certainly the thing you want to focus on are those 45 to 64-year-olds. That's the number that really sticks out. Now, what do 45 to 64-year-olds do that has some implications for construction activity? Well, number one, that's the age when where income tends to maximize. Most households, most people reach their peak income somewhere in their late 40s, early 50s, or early 60s. So you expect retail activity to pick up. Those folks are spending money. You'd expect maybe upper-end retailing to pick up pretty strong as you see strong growth in these peak income earning years. As one takeaway. On the housing side, 45 to 64-year-olds, custom and luxury housing, obviously that's the kind of homes they're buying. But I think in particular, that's the age where households tend to buy second homes, vacation homes, timeshares, things like that. So I think you'd expect to see some pretty strong activity in that market. Another big number there is this 18 to 24-year-olds. That's a 6-year group, a very focused group, but a pretty strong number there. Obviously, that was selected for a reason. That's higher education. So you expect some pretty strong growth in construction in the higher ed markets given those numbers. And then number 3 is this 65 to 84-year-old, longevity picking up, even though the baby boomers haven't moved into that phase yet. So you expect to see maybe some growth in the healthcare market. So upper end retailing, on the housing side, custom luxury, second homes, vacation homes, timeshares, higher education, healthcare would be markets that we'd expect to see some pretty healthy condition coming out of these demographic trends. And those were exactly the markets where we did see the best construction activity over the last decade. So I want to use, kind of think about that moving forward in terms of what the Census Bureau is telling us about population growth this current decade. And they're seeing a bit of a slowdown. 27 million persons added last decade, a little bit under 25 million added this decade. But, you know, surprise, surprise, we've all gotten 10 years older over that period. And so you see very different trends. And I think, you know, number one on the list is baby boomers, you know, population beginning in 1946. So by 2011, the leading edge of the baby boom was turning age 65. And so by 2020, we now have fully half of the baby boom population that's 65 or older. So you're seeing, you know, the strongest growth in our population coming from these leading edge of the baby boom population that's moving, I won't say into the retirement years, but moving into their post-65 years. So what would be the takeaway from growth there? Strongest growth this coming decade is in this 65 to 84-year-old. Well, I talked about healthcare last time, you know, for that age group, and in fact, the age 65 population uses healthcare at 5 times the rate of the under age 65 population. So you expect pretty strong growth in healthcare. On the housing side, seniors housing, active adult housing, I think would be markets that you'd see. And as this population ages, I think increasingly the integration of housing and healthcare options, assisted living and things like that ought to be a strong market moving forward. And then the only other big growth there are the 25 to 44-year-olds. Those are the children of the baby boomers entering the workforce. Hopefully entering the workforce, not living with mom and dad. And as they enter the workforce, hopefully, renting homes, buying starter homes, working in offices. So I think we'd expect to see some growth in those markets. So I think the takeaway here is, as I said, healthcare, seniors housing, the integration of healthcare in housing opportunities, offices, rental units, starter homes. So a different set of markets, you know, just by moving the population forward 10 years, a different set of stronger construction markets this decade. And I think in some fundamental ways, almost the mirror image of what we saw last decade. Virtually every construction sector that was strong last decade is likely to moderate some this decade. And virtually every sector that we saw that was kind of a little bit weak, a little bit below trend last decade, should see some growth this decade. Only exception being healthcare, which was, you know, reasonably strong by the demographics last decade, very strong by the demographics this decade, and I think even stronger by the demographics moving beyond 2020. Obviously, with baby boomers moving into this age range, general longevity increases that we're seeing in our population, healthcare is going to be you know, I think a market that's going to see a lot of potential moving forward. So let me end up there. Hopefully, left a couple minutes for questions that you might have for either Amy or myself, and sum up some of the points that I tried to make in my quick run through the construction outlook over the next few years. Starting with housing, as you know, covered just a few slides there, but the housing recovery well underway. One of the main bright spots in not only the construction market but the broader economy. But still, as I said, still a lot of growth to go, still below the long-term trend that we would expect to see in home building activity moving forward. Number two, the building market, as I said, moving in the right direction, but been very slow, painfully slow to recover. The market fundamentals, I think, are finally really virtually uniformly positive. Property values have turned around, they're recovering. Vacancy rates, rents, virtually all positive, moving in the right direction. So I think a very solid foundation for recovery on the building front. Thirdly, architecture firms, and they have been reporting generally stronger activity in terms of design billings over the last 18 months. So design activity, I think, is firmly pointing to an upturn in construction activity moving forward. And then finally, our outlook, healthy growth in non-residential building spending this year, and momentum building moving into 2015. I think, though, the pessimist in me says we could have expected stronger numbers, though, after the extent of the downturn that we've seen. Would be nice to see some uniformly strong double-digit growth numbers on building activity, as opposed to these single-digit numbers that we're just finally seeing, sort of 4 years into this recovery. But hopefully we'll get there. Hopefully year by year we'll see improvement, and like I say, I think a good solid base to build off of moving forward. Good solid fundamentals, demand starting to come back, and looks like the economy starting to cooperate too. So. Let me leave it there, and if I've got a minute or two for questions or anything that you have of Amy, be happy to try to address those, or any observations you want to make in terms of conditions that you're seeing in your own practices that may or may not be relevant here. Go ahead in the back.
The trend in merger and acquisitions in the architecture firm, do you see a correlation between that and the slow recovery of positions in the architecture sector?
Interesting question. For those of you that couldn't hear it over here, this uptick I talked about in merger and acquisition activity, is that correlated with the slow recovery in architecture positions? And my instinct is no, that if firms wanted to add positions, I mean, we're seeing in aggregate no growth, very little growth in positions. I do think that firms that want to grow are, as I suggested, sort of doing it through the merger and acquisition route rather than the organic growth route. But I'm not sure if that's, I mean, I think what you're suggesting is that's depressing overall hiring in the profession. I don't think so, but let me think about it a little bit. I guess I hadn't really thought about that connection. Might be something there. Interesting thought. Question here?
If activity picks up and prices go, will inflation have a damper effect on continued recovery?
Yeah. Question about inflation. And inflation, are you talking about building materials costs, labor's costs, property values, all of the above? We have seen some, I didn't talk anything about materials prices here. We've seen some inflation in materials prices, more so on residential materials prices than non-res. So the products we're seeing some inflation are now are lumber and wallboard, plywood, things like that, more resident, smaller scale stuff. We're still not seeing it so much in sort of steel and other things you would expect to see in the non-residential market. I think if this recovery were stronger, number one, and number two, we were seeing more construction activity internationally. And I didn't talk about that, but kind of international markets have quieted down. We would see more inflation in materials costs because it just takes time for manufacturers to ramp up their production. I mean, the downturn has been so severe that these were not, these production facilities by and large were not put on hold. They were shut down. I mean, if you go 6 or 8 years with not producing something, you don't just kind of flip the switch and get them running again. So I think no, given how much, how weak the recovery has been. On the labor front, construction, unemployment rates are still running 10 or 11% nationally, so you wouldn't expect to see a lot of inflation there. So I guess I would say I don't think so unless things really start to pick up again, either domestically or internationally or both. It certainly is a concern. I mean, I think we're hearing much more about supply conditions as being a factor. I didn't talk about financing, but financing is still a big issue for the construction industry. On the home building side, you hear a lot of problems about entitled land ready to build on as being an issue. labor availability, materials prices, and things like that, I think are all top of mind for folks in the industry, but they haven't kind of bubbled over yet to be a big problem. Go ahead.
How much does military construction constitute of the overall construction, and where does it reside in your three categories?
Well, it's institutional. It's clearly in there. I don't know the percentage. I'm pretty sure it's single digit, and I would guess low single digit in terms of overall activity. I think the issue, though, is that that's nationally. If you're in a market, D.C., Virginia Beach, Norfolk, that area, Southern California, some of those markets, it's a pretty significant part of overall activity. So, could play a role on a market to market basis.